I'm expecting the potential for an explosive move if things go well here in terms of the monthly price for gold and for silver. And if that happens, I think it could change the whole environment very quickly. And we can even see gold finally breaking out from that triple top that we've had. I mean, production for gold is falling, accumulation from central banks, commodity producers not spending enough, deglobalization trends happening, 60-40 portfolios, as popular as they get. And so something has to give here. And if that occurs, I think it will favor a lot of commodities, and gold and silver will be on top of that list.
Tavi Costa is a highly regarded financial expert who holds the position of Partner and Macro Strategist at Crescat Capital, a prominent investment management firm. Tavi Costa anticipates a potentially explosive market movement in this video, especially if gold and silver prices align favorably monthly. According to the latest long-term forecast, gold price will hit $2,000 by the middle of 2025 and then $2,500 by the end of 2026. Gold will rise to $3,000 within the year of 2028, $3,500 in 2031, and $4,000 in 2032. In the first half of 2024, the silver price will climb to $28. In the second half, the price will add $5.88 and close the year at $33.91, plus 37% to the current price. As per Tavi, the most crucial and relevant metric to monitor is the accumulation of gold by central banks. Despite a year-on-year decrease of 103 tons in purchases during the second quarter, net purchases by central banks worldwide still hit a record-breaking 387 tons in the first 6 months of the year, according to the latest data compiled by the World Gold Council. Meanwhile, Tavi Costa believes countries must accumulate more gold reserves to support a gold-backed currency. In his tweet, Paul Koshi mentioned, America's gold reserves hover around 8,100 tons. BRICS nations collectively aren't far behind. This considerable gold reserve pool places the alliance almost on par with the United States. We are presenting a glimpse of Tavi Costa's insights from his recent interview with the Vancouver Resource Investment Conference. Before we continue to delve into this discussion, we request you to subscribe to our channel and activate the bell icon for timely updates.
Gold to me is it's very close to make a historical breakout here very soon. The reason why I've been posting silver, it's because I've been following silver for a long time, and we've had a very large run from 2016 or so, or 2015, all the way to 2020, and then since then we've had a major consolidation pattern, which really happened during the time when the Fed started to or the market started to price in that the Fed would do the steepest hikes that we've had in interest rates, and even tightening of monetary conditions that we've had in a long time. It had an impact on silver prices, unfortunately. Now, looking at resistance that we've had in prices throughout all the way back to 2011, we've been hitting this resistance for some time now. And I think that, today, this month, literally this last day of the month, we could potentially be closing above that resistance. And I would probably weigh 10% of my technical ability to analyze markets, although I do think that that's an important inflection point for silver. If we do see, we do know that silver has a reputation of being having explosive moves, and if that's the case, where we could potentially be taking out an important resistance that could potentially become a support now, things can get very positive very quickly. I mean, I actually would suggest everybody to look at what happened in the first 72, 73, or I should say 73, 74 recession, which was very stagflationary at its nature, and see what happened with silver prices during that period. And it was, silver did incredibly well during that period, and for many reasons. It was a stagflationary period. It wasn't like 08. It wasn't like the early 2000s at all. And I think that's something to be to point out, something to be more aware of. And I think we're going to see that again. The BRICS situation is definitely interesting, and certainly another sort of reflection of this multipolar world that we could potentially be in. And I hate using that word, it's been used so many times, but it's sort of true, and it's taking it will take time to be to really work through the system, but it certainly is occurring. And I would say that the biggest most important and relevant metric that people should be following is what Ronnie pointed out, which is the accumulation of gold by central banks. And the only way to create a gold-backed currency is to have enough gold in your reserves. And we look international reserves across the globe. Gold is still the smaller percentages that it has been throughout history as a equivalent to other periods like the 70s when it comes to international reserves across central banks. And I think there's a lot of room for that to change, and even in the U.S. as well. So Treasuries is still by far the largest holding of most central banks, and I don't think that will be the case in the future. I think we're going to see a big change in terms of the allocation, and gold will likely become at least a more pronounced second option, at least. And that is, it could be aligned with gold prices rising along with interest rates rising, which is what we saw in the 70s. And so this whole idea of the correlation that we've had recently with interest rates and gold could be in the process of actually changing.
During the interview, Tavi Costa maintained a bullish stance on gold and commodities, driven by his belief in their structural advantages. The gold market rallied to a 3-week high last week as the latest trade data from the Commodity Futures Trading Commission shows a solid increase in long positioning and a sharp reduction in bearish bets. Given the historically high gold to silver ratio, which currently stands at around 80, Tavi believes silver's downside potential is limited. The gold-silver ratio has been used for centuries as a measure of the relative value of these two precious metals. Historically, the ratio has fluctuated between 47 and 80, with a higher ratio indicating that gold is relatively more expensive compared to silver, and a lower ratio indicating that silver is relatively cheaper. Tavi Costa is optimistic about the long-term outlook for gold and silver, emphasizing that despite short-term fluctuations, the gold market is now net long by 39,242 contracts. During the survey period, December gold futures hit a high of $1,966.50 an ounce. Bullish momentum pushed gold prices to $1,980, but wasn't enough to break that long-term resistance level. Let's get back to the interview.
I remain bullish. I don't think, everything has been holding up very well. Gold hit a triple top recently, has been incredibly resilient. I mean, look at what's going on with real rates. Real rates are surging recently, and they should be crushing gold. And gold is holding up very, very well, very resilient. It's incredibly impressive. And so to me, I do think gold is going to become more and more this defensive asset 60-40 mindset. At a period when those valuations for equities and valuations for bonds have been still very expensive historically speaking. And so gold is going to have to kind of fit into that, and we're already seeing that across central banks. I think central banks are kind of leading the pack in terms of accumulating the asset in order to enhance the quality of their reserves, in order to also prop up the credibility of their monetary systems. And as we see that occurring globally, it's hard to believe gold is not going to lead the way. I've never seen a gold cycle that didn't trigger a commodity cycle. I mean, show me one. I mean, every time gold breaks out to new highs and really has a sustainable rally, when did that not cause commodities to do the same? And so I think that will be the case here, especially when you have the very important aspect of the aggregate capex among most producers is still at historically depressed levels, and that to me is very telling. Silver is not too far; it's an 88th percentile historically. Gold is at the 60th percentile right now. So So, it's time to take the contrarian point here in terms of being long the metal. And I think that we're getting very close. And as far as how much can it go down, it's the same aspect with the Brazilian equities. I mean, maybe PE ratio can if there's a global recession, PE ratios can go from, I don't know, in a business that is trading at 3 times earnings to 2 times earnings, relative to a US business that can go from over 100 times earnings to maybe 20 times earnings. So I think that the impact on the compression of multiples is potentially much worse in the US relative to other places. And the same will happen with gold and silver. I mean, the reason why gold or silver has been so resilient is because the gold to silver ratio is already at 80. How much worse can it get from here? It's already at historical high levels. And so, maybe it can go to the 90. I don't know. But do I want to take that bet that it likely will be much lower in 5 to 10 years? Yes. And why would I wait from 80 to 90 if I think the process of accumulation starts now, personally, not after a breakout. It starts before that. And so, I think again, the risk is skewed to the risk reward is skewed to the upside here. And so, and the silver as well.
The bullish outlook is reinforced by the ongoing accumulation of gold by central banks worldwide, highlighting its growing importance as a strategic asset. As investors, it's crucial to consider how these projections may influence our investment strategies years ahead. Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.